Rashmi Shah here from Simplicity Investing. I'm doing this webinar from Dallas, and Sankit is there with me. And before I start my today's talk, I appreciate you coming on Saturday morning and watching our webinar. Now, I want to make certain few disclosures that this webinar is only for investors and clients who are residents of India. This is not for promoting any investments in the United States of America for US citizens or North American citizens. And I'm not going to talk about any specific stock or promote any investment products on this webinar. This webinar is only for the purpose of education and talk about what's happening in the financial markets from Indian perspective, from Indian investors' perspective. So with that, I begin my this thing, and I also recommend that please free to ask questions on the chat, which is on your screen. Feel free to ask any questions you have, and at the end of the session, I will give the answers. I'll answer those questions. Now, this I'm going to talk about for 20-25 minutes, and then we'll take the question sessions. So this is my second webinar. Last Saturday, I did one where I talked about the impact of Corona-19 virus on the global economy. And so as a continuation of that, this is a second webinar. Okay, so here we start. Now, what happened to the market? So everyone, in last 1 week, I'm getting a lot of questions why markets are going up. So exactly 1 month before, on 15th March, when markets were around the bottom, I was getting questions why markets are going down. Why markets are going down, and now I'm getting questions why markets are going up. So on February 14th, markets were at 52-week high. Most, like in a BSE, Sensex was at 52-week high, Nasdaq was at 52-week high, Dow Jones was at a 52-week high. Not only 52-week high, they were at all-time highs. And within a span of 30 days, the markets fell by 30%, and they were at 52-week lows. And now again, it has shot back almost 50% of the fall, and they have rebounded by 20%. So people are asking me what happened, why they're going up when they're supposed to go down, correct? Because in last 1 month, more than 125,000 people lost their life. The number of deaths are so many. There are more than 1.5 million people who have got impacted by coronavirus. Still, there is 80% of the world is under lockdown phase. Now, in spite of that, why the markets are going up? And also, you must be reading in the news that 1 out of 7 American person has lost their jobs, and this is highest unemployment rate in the history of US after the Great Depression. Now, same case, unemployment is going to increase in India too, but the numbers, nobody knows that. So in spite of all this bad news everywhere around, why markets are going up? And it's a very good question. I'm going to try to address that question tonight. There is a logic behind it, why the markets are going up, and I'll share that information with you in the coming few slides. Now, if you notice that what happened in the market to the markets is on February 14, 2020, Nasdaq was 9,800. On March 23rd, Nasdaq was at 6,860. So it came down 30% down. This is the steepest fall in the history of global stock market. And from there, it came from 6,860. It closed today at 8,650. So if you notice that, as regards Sensex also, it's on the same trajectory. Sensex was 41,000 in February. It came down to 26,000 on March 23rd. And from 26,000, it has gone again back to 31,500. So now, of course, Nasdaq has recovered much faster, and Sensex has recovered a little bit at a slower speed than Nasdaq. So why this is happening? Why such a steep 30% fall and then 20% recovery? Now, this is the highest volatility you have seen ever in the financial markets. So from here, where do we go? Very good. So these are the questions every investor, everyone is trying to say, find out and what we should do. So now, a few things based on the information and data. I'm going to what I think I'm going to share that with you. What is happening in last few days? Since 80% of the world is under lockdown, we are getting bombarded by most people when they're at home. They watch television news 24/7, and it's a depressing news, correct? You see so many people dying and sensational news and police going after people who are walking on the streets, and the number of patients dying everywhere is increasing, and all sad stories. And in spite of that, the markets are going up, correct? And on WhatsApp, everyone is sending hundreds of messages, 80% of which are fake, make-up stories. People don't know anything and they're just sending it. And in spite of that, markets are changing. So my question, one of the key reasons, what I see in this thing is how humans process information. So if you're getting affected by that media and news, you won't understand why markets are going up. So the biggest challenge we all should face is ask ourselves how I process all this junk information which I'm getting. You need to analyze that very properly, because this will help you in taking the right sensible decisions on your career, on your investments, and also on your the world is not going to end. Though 150,000 people have died all over the world, still the world has 7 billion people across the globe. So we need to look in the right perspective what's going on. So then you'll understand actually why markets are going up. So I'll share some different insights, correct? So as I said, extreme volatility turns and twists. It's like a Hollywood or Bollywood action thrill movie. First, we were optimism in January, then sudden panic in February, and now recovery in March. So the panic was there because in January there was so much optimism. So there were huge derivatives and leverage positions in the stock market. So as I've been telling you that there were more than $20 trillion of derivative positions, long positions in the global stock market. And as this coronavirus lockdown news started keeping in, they had to liquidate those $20 trillion long positions. So that created a cascading impact on the global stock market. And since we are living in the technology age, the news spreads fast. Every stock market in the world, every hedge fund manager, brokers, bankers, they started liquidating the positions. And that created massive impact. And that's why the market fell at the fastest rate in the world. Now, by end of 15th or 20th March, most of these positions were liquidated because 30%, normally people take a derivative position with a 10% margin. So when markets fall by 20%, that margin is gone. So bank takes the loss. So bank will never like to do it. They have a stop loss and they liquidate the position. So most of the positions got liquidated by middle of March. So the selling stopped, correct? The selling stopped. Then in that panic, there were some smart investors who bought. And so there were more buyers and less sellers, and markets started slowly recovering. And as the bad news started spreading, some speculators went short and they got trapped. So this created a cascading impact. Secondly, also from 15th March onwards, the US government took a lead of pumping in $5 trillion in 1 week in the stock market. And as of today, almost $10 trillion globally has been pumped in the financial markets in the developed economies. So $10 trillion is 10% of world GDP, which is a huge amount. So massive stimulus. And in next 2 months, another $10 trillion are going to come. So total $20 trillion of liquidity is going to get created in this market. And that liquidity also is helping the stock market to recover. But there's another reason which I'll share with you why this is happening, correct? Now if you look at the stock market, from a different perspective. So on February 14, the global GDP for 2020 was expected to be $90 trillion. And the stock market capitalization was $90 trillion. So now, when this coronavirus started impacting everywhere, nobody knew that how much damage it's going to do to the global economy. So around 20th March, the most of the analysts, most of the investors, or any experts didn't know how much damage to the GDP is going to do. So there was a question mark. If you see this, there's a question mark. They didn't know the GDP, how much it's going to be for 2020. And that's why the stock market crashed from $90 trillion to $60 trillion, because the markets want certainty. They want to assign a certain figure of how much business we are going to lose. Nobody knew. Then slowly things started turning around. Means economists, government started predicting how much it would cost, and around first week of April, the estimate came that the world economy will have $85 trillion GDP in this year, World Bank, and they started coming. So the damage to the economy was only of $5 trillion, but the market capitalization damage was of $30 trillion. So the market said, oh, we have oversold it. We are estimated much higher damage. That much damage to the world economy is not going to be there. And that was another reason for the market to recover, bounce back. So as of today, the stock market capitalization, the total value of all the stocks, listed stock in the world, today is $78 trillion, roughly. This is an estimate. It may be off by 1 or 2%, but it's a high level estimate this is. So when you see this kind of stuff, so that's another reason the market rebounded. So the panic went to an extreme end, and now it is coming to normalcy, correct? Still there's a gap of $8 trillion. So GDP is estimated to be $85 trillion this year, and market capitalization $78 trillion. So that has happened. Now this is at a high level. So now we'll zoom down further details wise, that certain sectors are getting impacted more and there are others, correct? Now, so what's next? So what's going to happen in the rest of the year? So from 16th, so we go take this break up into 3 quarters, up to June, then July to September, and from October to December. So between 16th April, from today till 30th June, we'll see flattening of the coronavirus curve, gradual opening of the world economy. So everybody today is talking, India is talking, how we restart the economy, US is talking, we'll see that. So more bad news has stopped coming up. We are talking about starting the economy. So that's why the markets are rebounding, and there will be quarterly results of all the companies coming in. Now everyone knows that this quarter is going to be bad, so nobody has any all the bad news is factored in the stock prices. So we don't see markets correcting because of the results, quarterly results. Everyone knows that the economy was shut down in the month of March. Now, so this is going to be the consolidation phase. You won't see massive fall again from this level till before 30th June. You may see 5% here and there, up and down. We may not see even the market's going up more than 5%, not coming down by more than 5%. So till 30th June, it will be in the trading zone. After first week of July to 30th September, in that quarter, what is going to happen? The world will actually assess more specifically how much damage it has done to different sectors. So how much damage is to airline industry, how much damage to tourism industry, how much damage to manufacturing sector, how much damage to the different sectors, correct? So that estimates will start coming out from July to September. So if the damage is more than expectation, then market will slightly go down, adjust. If damage is less than expectation, that numbers will start coming up. So also then we'll start coming to know at a micro level the companies which took a massive hit, and which companies are going to go bankrupt, which businesses are going to go bankrupt. So sector-specific news will start coming in the July to September. You will see more mergers, acquisitions happening. So then October onwards, the US elections will be at its peak, correct? So that will drive the market in the October to December. And in the fourth quarter of this year, we will come to know what is the long-term impact of this coronavirus. This coronavirus is going to create a long-term impact on the behavior of the governments, on behavior of the corporate sectors, and individuals. Our lifestyles are going to change. How we adjust to a new lifestyle and what does it mean to the economy, that will happen. And by end of December, we'll come to know what is the impact of how much progress we have made on the vaccine front. Because if we have not made much progress on the vaccine front, again the virus will come back in the month of January, because it will come back in the winter, correct? So it's a seasonal flu. It will come back in winter, and that's changes might happen. So these are the major events which are going to happen in this year, and this is going to drive the stock market prices. Now, most of according the way I see the market today, most of the bad news which was not factored in the month of February, it got factored in the fall of March, correct? Extreme bad news was there. And market, when the damage was of $5 trillion to the world GDP, the stock market corrected by $30 trillion. So the value, it went 6 times more. And then it realized that, okay, the economy is not going to fall by that much. So it recovered. I think now the rest of the year, we'll see consolidation phase and we'll see a trading. But certain sectors now, it will be, the volatility will be there within the sector. So overall indices will remain same. So let's say the BSE in Sensex may remain at 35,000, between 30 and 35,000, but within the 30 to 35,000, there'll be a lot of sectorial changes. Some sectors will cross 52-week or all-time high, and certain sectors will further go the damage. And that's where the investors need to focus on. And then, because everyone is going to realign their portfolios, and that's the key which is going to happen in this year. Now, but what we need to realize as investors, that markets, the job of the market is to go up and down. Now, if you go by news and get impacted by the news, you will always buy at the top and you will sell at the bottom. Now, today I've noticed that in February, everybody wanted to invest. In March 15th, everybody was panicking and they want to sell. So that was a very good time, March 15th time, when the markets were at the bottom to invest. But that and very few people had the courage to invest. And as markets started recovering, people are feeling more comfortable of investing. Now, so why that's happening? Because of a behavioral analysis. So my key point here is, you should not invest based on what news is coming. You should invest based on what you want to do. You know that the economy is going to survive, you're going to survive, and you're investing for 3 to 5 years time. Then invest in sectors and companies which you feel are going to, businesses which are going to do well. You'll be fine. Don't try to time the market, and that's where the problem is. The job of the market is to go up and down. Your job is to create a strategy and a portfolio. Now, if you do that, you will be very good. Means you'll be able to navigate through this volatility. Now, the other thing which is going to happen in this year is lots of bad news, sensational news, TV, media, WhatsApp messages, social media is going to publish. Very few, how many of you have seen very analytical objective news analysis on the TV or WhatsApp or newspapers? You need to focus on objective news and then take analytical decisions, correct? And that's very difficult to do in this age. Now here I'm projecting that 4 different kinds of scenarios of coronavirus. So if virus is contained and the recovery is slow, then market will gradually recover. If virus is contained but the economy recovers fast, then the market may cross the February high. Market it bounce back very sharply from this level also. If virus comes back but the economy grows slowly, then we'll see again a trading market and gradually. When virus comes back and the economy also bounces back. So these are 4 different kind of scenarios which can happen. So we need to understand. So this at a macro level, you understand that and navigate your portfolio and investments and psychology. So this is at my level I do to understand all my clients or portfolios and how I navigate through this. So this is at a macro level, you have to do that. These are the 4 different kind of scenarios which can happen. The other thing, as I said, this slide I have taken from my previous webinar to reinforce that there were only 4 sectors which were working in the month, which are working today. One is healthcare, IT and telecommunication, financial market, and FMCG and basic grocery. These 4 sectors are going to do extremely well. Their growth to the global GDP contribution is going to be higher than 2019. So if the global GDP was $90 trillion expected, it's going to be $85 trillion. This sector's share is going to be higher than what it was projected last year. So these sectors are going to do better and this way. Now, the other trend which we noticed this week, that the sectors which were beaten down extremely, those stocks flared up. So correct. So these are the sectors. So these are all the sectors I've mentioned. The maximum hit was taken by oil and gas. Oil and gas stocks and took down 50% hit. Then aerospace and defense. Then healthcare providers, insurance companies. Insurance companies in US. This data is from the US, not from India. Now, but the same pattern you will see worldwide. Like if coronavirus spreads too much in India, all healthcare insurance providers will take a big hit, correct? So insurance sector took a hit, healthcare payers, financial services, stockbrokers and banking. So if economy gets hit, NPS go up, correct? So financial services took a hit. Then global companies, banks, then automobiles, chemicals, real estate. So you see, and the least hit was taken by telecom, pharma, and retail. Retail means grocery stores and those kind of the food and basic essential services, and high tech. These sectors took the least hit. And so this was the trend we have seen, correct? Now, as the economy starts recovering, this sector will outperform compared to 2019. Now, the stocks here, which have taken 50% hit, they are recovering slightly. That's why you are seeing a bounce back in the... So, no matter in which sector you invest, if you have a strategy, you can make money also in oil and gas sector. You can make money in travel sector also. But this will take a much longer period than IT and... But you need to have a strategy. All these businesses are going to survive. All these companies are going to, means the best companies in this sectors are going to survive. But you need to focus on quality and have a strategy. If you keep on switching investments from one place to another, then you will take a very big hit, which we don't recommend for anyone to do that. And that's why strategy is the most important thing. So investing is an art. It's in a science. It's not impulsive investing, but most of the people do impulsive investing. They go by we call in market sentiments. So if market sentiments are there, people buy. Market sentiments are bad, they sell. You should avoid sentiments. You should focus on a strategy and long term. If you do that, you should be fine. So this is what I anticipate. So what I anticipate from today till rest of the year, markets are going to be less volatile than what they were there in the month of February, March, and first week of April, and they will be within a range. But within that range, certain sectors will do even better than last year, and certain sectors there will be a pain. Now, also within each sector, some companies, bigger companies and well-managed companies will do extremely well, and the companies which have a lot of leverages, they will face problem. So you need to focus on high quality, and quality of investment should be. So I stop here and I'll take your questions. And I also want to make an announcement that next Saturday I'll be talking again on taking another webinar, which will be on banking and financial services. So I'll try to do one webinar every Saturday at 11 same time, and next Saturday I'll be talking on banking and financial services, sector specific. So now the first question I'm taking, what will be the impact of the world trying to limit business with China? Okay, very good question. So before I answer this, give you an answer, let me share another data point with you. If you see the total market capitalization of country specific, China's GDP is $12 trillion, but market cap of China, the stock market cap of China is only $8 trillion. The market cap of GDP of US is $22 trillion, but the stock market cap of US is $40 trillion. Japan, the GDP is $5 trillion, market cap is $6 trillion. India, the GDP is $2.5 trillion, market cap is $2.5 trillion. So why China is getting less valuation? Because people don't trust. Credibility is not there. Accounting standards are not there. And that's why the valuation of Chinese companies is much less than the highest valuation companies in US get. Now India gets a fair valuation because Indian companies are much more honest, transparent and regulated than the Chinese companies. Now having said that, since the world is going to open up, you can't build overnight supply chains. So still China will be very dominant for another 2-3 years. It will take a long time for every country, every company to change their supply chain. Overnight you can't change. So China will be still an important part of the global economy, and it will continue to be a dominant player. It will continue to be dominant player for next few years. And we'll see after that what happens, how the world does the adjustment. Now, will the world try to limit the business? Of course, officially US is saying we want to limit the dependence on China. Now, how successful they become? It's wait and watch. Now, it depends on how countries like India, Mexico, Vietnam, Taiwan, they take advantage of it. So we'll see over a period of next few years. Yes, the trend will be higher, but the impact will be slow and gradual. The next question is, which sectors to avoid given the... that's another question. Can you elaborate the procedure of how to invest in the US market and what are the tax and FEMA regulations? Okay, yes, every Indian citizen, resident can invest in US. So like how FFIs invest in India, you can become an FFI and invest in US. So when you invest directly in US, you have to open an account with a US stockbroking firm, which any Indian resident can do that. When you open the account with a US stockbroking firm, you don't pay taxes in US, you pay taxes in India. As an Indian resident, you are allowed to transfer $250,000 every year per individual to any investments outside India. The only change that India has made from 1st April this year, when you remit the money, 250, any amount from outside India in dollars or any other currency, 5% TDS is deducted, and that TDS is used to offset against your Indian income. So that is one change they have made from 1st April. Now, yes, every Indian should invest a part of the portfolio outside India, but having said that, you have to be very clear on the quality of investments, and you need to take a professional advice how to manage those investments. It's a very good strategy to invest, and 20% of the portfolio should be globally diversified. Yeah, I hope I've answered that question. As regards FEMA regulations, is they up to 250,000 officially you can invest. There is no issues, and taxation is in India, and the long-term capital gains is 2 years. So in Indian equity, the long-term capital gain is 1 year. In US equity, the long-term capital gain is 2 years. Yeah. The next question is, which sectors to avoid given the unknown produced by a virus? Which sectors to keep investing using instruments such as SIP and STP? Very good questions. So the sectors which you need to keep investing, everyone needs to invest in US technology companies, because if Microsoft, Google, Apple, Facebook, they were not there, the global lockdown would not have been possible. More people would have died. So these companies are going to play even bigger role going forward, and they are very well respected, good companies. So that is the one sector everyone should be there. Every Indian should be there. Now, to make investment in that sector, you have mutual funds in India, and you also can invest directly. So then the second sector you should be investing is in the pharma sector, healthcare. Then you should be investing in MNC companies. You should be investing in FMCG companies. This and banking and financial services. These four sectors you should be having, because banking and financial services is the lifeblood of India. And without banking, now as coronavirus has taught us that even in these bad times, sitting at home, if you have digital money, you can operate. If you have cash, you cannot operate. So after demonetization, the biggest another shock which Indian cash economy has got is this coronavirus. So the digital economy is going to play a more important role. So banking and financial services is going to expand. So these are the sectors. Now, I'm not saying you avoid. Now, if you avoid manufacturing sector, no, you should invest a part of the manufacturing sector, but the horizon should be long and the quality of companies should be very good. Now, all the sectors have been reevaluated based on what happened last 2 months. So even if you invest in hotel industry, like, it should be fine because the valuation has already come down. So only thing which you should avoid is hopping from one sector to another sector. You should not trade. Those who invest and have a strategy will make more money. Doesn't matter in which. Now, the sectors to actually avoid will be small, in India's and even US also, people like small cap stocks. I would avoid small cap stocks. I would prefer, instead of saying avoiding sectors, I would avoiding small caps and have only limited exposure in mid caps. My 70% should be 70 to 80% should be in large cap. Yeah, the next question is, how is unemployment going to affect the stock market? Yes, very good question. There is going to be a massive change in how we work. As I said, this is the first time the world has experienced where 70% of the office jobs, people are working from home. So now more and more people are going to work from home, and work from home and remote places has very good points and very bad points. The good points is that companies will come to know that the efficiency will go up if you work from home, and the transparency, the measurements and everything will be at a different level. So all of us will have to change how we work. Now, there will be a certain section of people who will be unemployment, and they may not be able to come back in the job market. So those who are above 55 will find it very difficult to come back to the job market if they lose their jobs. Youngsters, they can change, correct? They can realign. So the job market also, there is going to be, like how in stock market sectors are going to change, in job markets also certain section of people will benefit, certain section of people won't benefit because they won't be able to change, and that pain will carry on for next 2-3 years. Yes, there will be a certain pain there. Every company will look at their employees and see how to rebalance the employee cost. They will focus. So let me put it differently. Big companies will see whether should I invest 1 crore in my employees in their training, or should I 1 crore should I put in my technology and make process automated. So there's those kind of questions all the managements will be answering, and my answer to this will be more and more money will be spent on automation than spending on manual work. That change, we'll see massive change will happen. So what people should do is they should upgrade their skills, focus more on education. See, unfortunately in India, we don't give too much importance to education once we graduate and go in the job market. Every 5-7 years, we should upgrade our skills and do this. So then you'll be fine. There'll be a massive change, as I said. There'll be some pain in that thing. Yeah, I'll take the next question. What about pharmaceutical sector? Will it do well? Yes, pharmaceutical sector has hit 52-week high, and it will continue to do well for as more and more focus is going to be on healthcare. Also, what has happened is Indian pharmaceutical sector was in a bad limelight in the US with FDA. All FDA restrictions were removed because of this coronavirus and exports. And as I said, the US government wants to depend more on India than on China, correct? So Indian sector will benefit there. The pharmaceutical sector will do well. So next question I got is it good time to keep money in the current shares which I have invested, or if I have earned enough profit, can sell the shares and reinvest? Yeah, if you have some winners in your portfolio, I won't sell everything. I would only trade 10 or 20% of that if you want to trade. Otherwise, I'll stay invested. Now, if I have loss making shares, I will see what is the future of those companies and I'll consolidate it, because some good companies also have come down. I may switch. So I'll give you a classic example. If I have too much small cap portfolio, which is giving me minus 40% return today, and even banking and financial services has gone to minus 40 today. So what I'll do is I'll move money from small cap to banking and financial services, because banking and financial services will bounce back faster. So it's like when I go to a railway station and because of some changes, the passenger train and the express train ticket price is same. And so which train you'll catch if the price is same? Of course, express train, correct? So banking and financial services is an express train and small cap is a passenger train. And if both are giving me minus 40% return today, I'll shift my money from small cap to banking and finance, because first banking and financial service sector will go up, then small cap will go up. So you have to review and reevaluate your portfolio, and don't do it yourself. Take some experts' advice and follow the process, and don't do everything one day. Do it in 2, 3, 4 lots and then work it out. Given the scenario, next question I'm taking, given the scenario, is it wise to keep investing in banking sector? Also, which sector you recommend one should invest? As I said, you should be diversified in 5 sectors minimum, and banking and financial services is the lifeblood of India, and it has taken a very big hit. It's almost 40 to 45% down, and it's a very good sector. I'm going to talk about this sector next week. You should invest at that, and also at the same time you should be invested in IT sector. You should be invested in global equities and different sectors, correct? Yeah. But you should have 5 sectors minimum in your portfolio. Next question is, how prudent it is to invest in new fund being created by Motilal Oswal on S&P? Will rupee lose badly against dollar? Oh, this is a very good question. Yeah. So Motilal Oswal has come up with ETF on S&P 500. Now, ETF is a very good product for long term. In short term, ETFs are not very popular in India because it's traded like stocks and the liquidity is less. The other disadvantage, there are certain advantages and disadvantages of ETF. Now, ETF is considered as a stock. It's not a mutual fund. You have to buy on a national stock exchange. Now, the problem with ETF on S&P 500 in India is quoted during off-market hours, US market hours. So, US market is closed at that time. So, again, the buying and selling spread and liquidity is very low, and the true price discovery is not there. It's a good product, I would say that. You can experiment in it, but I won't put a lot of money in it. It will take some time for this kind of products to be popular in India. Eventually, they will be very popular, but as of today, no. Yeah, next question is, the oil sector is in crunch because of oil war between Russia and Saudi Arabia, and also airline sector are in debt. What kind of impact will have them on the market in Q3 and Q4? Oh, good question. Yeah. So airline, every airline in the world is today bankrupt. Every airline, no matter whether it's Emirates, Air India, Indigo, Delta, no matter which airline. But if airlines were not there, world economy is not going to be there. So every government of every country will have to bail out at least 2 or 3 airlines in their countries. Otherwise, the economy will suffer. So airline industry is going to bounce back, number one. But it's going to bounce back. It will take some time. There will be some pain, like how banking and financial services in US got hit in 2008. It took 3-4 years. So Citibank stock, which was of crashed from $600 to $1, and it went again back to $70. So if somebody invested in Citibank in 2008 at $1, it went to $70 from there, correct? But it crashed from $600 to $1 before that. So same cases with the airline. Now today airline stocks have come down so drastically. I'm not talking about Indian airlines, global airlines, and they are going to bounce back because without them we cannot survive. The government will have to bail them. Same case with the oil sector. Oil sector is not going to go anywhere. Yes, the oil prices are going to remain low. The reason oil prices has crashed because nobody is driving, correct? 80% of the consumption has come to a standstill, and the oil is getting produced every day. So there is no space to store that oil, and that's why oil prices crash. And that's also one reason. The second reason is also price war between Saudi Arabia, US, and Russia. All those things will get sorted out in a year's time, and it's a long-term story. It's not going to vanish. It's a good sector to invest small amounts, but it's a long-term story, not a short-term. Apart from US, do you recommend which market will be attractive? Apart from US, India, I would recommend Japan. As I said, Japan GDP is $5 trillion and market capitalization is $6 trillion. So the market, that's the only country in the world which has a premium because ethical standards, transparency, quality of management, strong cash flows, very innovative companies. So in this crisis in February and March, the yen appreciated by 15%. So the rupee depreciated against dollar by 8%, and the dollar depreciated against yen by another 7%. So yen, almost about $20 trillion moved from US dollars to Japanese yen that time in the month of March. So yen is considered to be a very good currency also. So Japanese stock market also will do well. And that's a mature ethical stock market. So that's another economy where you can hedge a little bit. Yeah. I have answered that question. What about the construction sector? Will it be stagnant or pick up? No, construction sector. Now, construction sector has also two kind of companies, correct? Pure real estate, and there is a companies which sell products to real estate. So like cement, steel. Instead of investing in the direct real estate companies, builders or them, I would invest in cement and steel stocks because infrastructure, India has to spend a lot of money on infrastructure, on building roads, bridges, and hospitals, and so those sectors will do well. So if you are bullish on, if you want to invest in construction sector, I would invest in cement and steel sector rather than investing in direct real estate companies, because real estate companies, we don't know how the management is going to able to restructure their balance sheets, and that's going to be a key challenge because it's going to take some time for price adjustment in the law. In India is still over owned in real estate sectors, so it's going to take some time. What about auto sector? Yes, auto sector is already in the bottom of the cycle. Yes, you can invest in auto sector. It should do well from the current levels. It should do well from current levels. Faith can move mountains. They can say in scenarios, whom should we put in our faith in? You should put faith only on data, analytical data, and don't read too much news and media and all that kind of stuff. The world economy is going to survive. Innovation is going to put faith in science, data, and innovation. Yes, and good management. You'll do well. What are your views on telecom sector given the AGR issue from DOT? Yeah, that will get, so without telecom sector, lockdown would have not been possible. If we had only that BSNL landline phones like we had in 1970s and 80s, lockdown would not have been possible, correct? No. So lockdown is possible today because we all can communicate. I can talk to you on webinar, share knowledge, you can invest. So internet, telecom company is very important. They will survive. It will get sorted out in next 1 or 2 months. If India can't sort out that AGR issue, forget about competing with China and US. Just forget it. Yeah, it should do well. What is your view on private banks? Yeah, private banks took a little bit hit because of Yes Bank episode, but they should do well because they're technology driven, and more shifting will happen because technology is going to drive the growth. Technology is going to drive the reach, correct? So private banks are able to invest in technology much faster. Now we can't brush every private bank with Yes Bank. These kind of things do happen in the market, and private banks will do well. I have a portfolio which is giving extremely bad returns even before the coronavirus hit us, and in last 2 months it got hit further. What should I do? Oh, very good question. So I analyze. We have a lot of clients. I analyze the data of all my clients, and I said where we took the maximum hit and where we took the minimum hit in clients' portfolio. So what I saw that the clients who followed a process and disciplined what we had and stuck to the sectoral allocations and went by purely advice and data driven, their portfolios did well. Now clients who got impacted most was the clients who tried to reshuffle the portfolio more, who went on sentiments, who, oh, I don't like this. I like, a patient who goes to the doctor, I want this medicine because I want this. So a patient who advises doctor which medicine he should prescribe, that patient didn't do well. A patient who kept complete faith on the doctor. So you select a good doctor, ask 10 questions, but once you trust the doctor, follow his advice. Those kind of patients recovered faster. Yeah. So if you are having a lot of negative returns on all your portfolio, even before coronavirus happened, that means your portfolio was wrongly structured or something went wrong. You reevaluate the thing, change your advisor or go to a different advisor and work it out and rework the strategy. What are your views in the gold? Good question. Now, gold already has got the benefit in last 1 year because of the massive liquidity created by US Fed Reserve. Now, gold will go up from here only if US economy goes into depression, which I don't see happening. Today. We'll come to if gold will rally after month of December, if US is not able to. So gold is a hedge against US dollar. If US dollar doesn't do well, then gold does well. Now, whatever bad news of coronavirus was there, and the US government printed so much dollars, that's why gold went up in last 2 months. Now, I would be cautious on gold from at $1,800 an ounce today. It's almost close to $1,750. I don't see too much upside unless the US economy messes up, which I don't see today. As of today, no. But you should not invest impulsively on gold. Gold should be maximum 3 or 4% of your portfolio. Yeah. Mhm. Can India really achieve USD $5 trillion GDP? Uh, um, yes and no. It depends on how we structure our economy now going forward. Uh, See, you can't. In India, there is a big mistrust between the government and the private sector. Like that kind of mistrust is not there in US. In US, the private sector and the government, they both work hand in hand. In India, that case is not there. Now, how the relationship between the Indian companies and the government is there, and how India has a potential to be a $5 trillion economy, but it will depend on how we reform our economy. Correct? Yeah, it's going to be, I would say, 50-50 chance as of today, and I'll be able to give you a better answer in the later part of this year. Mhm. But India has a potential if they want to do it. Mutual funds or shares? Can we redeem the fund from mutual funds and invest in shares? No. Uh, you can have 70%, 80% in mutual fund and 20% in shares, because shares, when you do, why you want to do is you want to trade in the market, and trading is very risky. Um, you need to focus on your job, you need to focus on your profession, you need to focus on your career, and invest passively and build your portfolio. If you focus on your trading strategy and investments, then you can't focus on your job. I wouldn't recommend that. I would recommend, even if you get, how much more returns you can get by investing in shares than mutual funds? Only 1 or 2% more or 3% more. But why take a risk of your career? I would invest in mutual fund 80% and 20% in shares. Yes. Any more questions? Will India benefit a lot by companies deciding to move away from China? Mm, have you heard any official statement from any company that we want to move away from China? This is a media hype, correct? Uh, People will move away from China only if they find a very good alternative, and which is not so easy to find overnight, because the cost. So imagine if you're living in Pune and you want to move to Bangalore, is it so easy decision? No, there's so many things you have to take into consideration. Same way, moving a vendor or supply source from China to any other country, you have to factor in so many different things, and it takes some time. So I'm again saying is, it will take a couple of years to do that, yes, but what is going to happen immediately? Companies will stop getting more new vendors from China. They'll first get preference for my new vendors. I'll try to look at other place. If I don't get there, then only I'll go to China. That's going to happen. Okay, this is the final question. Which is the last group of stock which go down in the final stages of the bear market? Oh wow, this is a very good question. The last group of stock which go in the final stage is the large cap, which happened last month, correct? All the large cap stocks crash, like Microsoft, Google, Apple in US, in India, the Hindustan Lever, all Nestle, and they bounce back sharply again. So the large cap are the last one to fall down, and they bounce back, and that's what happened. Uh, in the bear market, the last stock to fall down is where the turnaround happens is the large cap. Okay, thank you very much. I appreciate it. And if you like this webinar, do subscribe to our channel. And I'm going to conduct another webinar next Saturday. Again, same time, 11 o'clock, on banking and financial services. Thank you very much. Bye. Thank you. Have a nice day. Bye.